Hey everyone, Richard Norris here. Welcome back to my channel. In this video, we'll tackle the old age question, repayment or interest-only mortgages. Stay tuned to discover which one better aligns for your financial situation when considering your next buy-to-let property investment. Now, for those of you who are new to my channel, my name is Richard Norris. I'm the founder of a company called PropertyConsulting.io, and we consult with individuals and help them to start and scale and build successful property portfolios. I've been investing in property for well over 12 years. I invest in the UK and Dubai, and I've successfully built a multi-million-pound property portfolio. So without further ado, if you are new to my channel, please make sure that you go and click the subscribe button and make sure that you click the bell icon as well so that you're notified of any new property content that we distribute on the channel on a weekly basis. So first and foremost then, what is the difference between a capital repayment mortgage and an interest-only mortgage? Well, by definition, a repayment mortgage basically means that you're paying off the principal loan amount and the interest. So let's say that you had £100,000 mortgage on a property, you're paying off the £100,000 over the duration of the loan term. Let's say that the loan term is typically 25 years for this example. It would mean that, and let's say for example that you were taking out an interest rate of 5%, over that duration of the 25-year term, you'd be paying off the 5% interest payments every single year, and you'd also be chipping away at the capital, and over the 25-year term the remaining balance would be zero. So you'd be clearing the loan in its entirety. Now, on an interest-only mortgage, what differs is you're just paying off the interest. You're not paying back any of the capital. So on an interest-only mortgage, the debt remains the same on the property over the duration of that term. So at the end of the 25-year mortgage term in this example, you'd still have a balance of £100,000. You've purely just been paying off the 5% interest payments every single year. And that's the main difference between the two mortgages. So you might be thinking, okay, well that sounds great, but which one should I use? Which one's going to be better for me? And what are the pros and cons of doing so, or of each mortgage type? So I'm going to explain that now as we go through the video. So the first thing I want to talk to you about is repayment mortgages. Now, typically a repayment mortgage is what we use as owner occupiers. We typically use that on our own home. Now, I think it's really important to discuss at this stage as well, like the difference between good debt and bad debt, okay? Because this kind of ties into the conversation and will help you to understand my opinion on which one's better, interest only or capital repayment, when buying and building a buy-to-let property investment portfolio. And honestly, most people don't understand the difference between good debt and bad debt because they still think that their own home is the greatest asset that they have. And actually, by definition, it's not even an asset, right? And I'll explain why. Now, so what's the difference between good debt and bad debt? Well, bad debt, by definition, is something that takes money out of your pocket every single month. So something like bad debt could be the mortgage on your own home. And it could be that capital repayment mortgage that we're talking about in this video. And the reason that that's bad debt is because it's not making you any money. It's not producing income. Every month you go to work and you earn a salary, you earn income, and then you use your taxed income to service and pay for your mortgage payments, which is a liability on the balance sheet because it's taking money out of your pocket every single month. So other things that are bad debt are like car expenses, a car loan, holidays, expensive clothes, shopping. All of those things are not income producing assets. They're not debt that's making us money. They're debt that's causing money to go out of our pocket every single month. So what is good debt? Well, good debt could be a buy-to-let property. If you've got an interest-only mortgage on a buy-to-let property or any mortgage on a buy-to-let property and it's producing you income and you've got a profit at the end of the month and it's making you cash flow, then that is good debt because we're using good debt to make us money. We're servicing the debt and we've still got positive cash flow left over. So it's adding income to our balance sheet. Another example of good debt could be information. Maybe you pay for information, you've joined courses, you've joined programs, you've paid for books, you've paid for knowledge. That's good debt because in theory, if you're listening to the right people and you're using the knowledge and the new information that you found and you're taking action on the knowledge, then you're going to see results and you're going to get what we call a return on investment on your initial purchase costs. Therefore, that is the highest ROIing activity in my opinion because knowledge doesn't leave you and therefore you're going to get an infinite return on any new knowledge that you learn because it's going to help you to make better decisions in business, better decisions when growing your property business as well, and help you to make more money and become more profitable. So you're constantly seeing an ROI. So now that we understand the difference between good debt and bad debt, let's go back to this whole premise of a capital repayment mortgage. So typically speaking, when you buy your own home, the property that you live in, otherwise known as your principal residence, you take out what's called an owner-occupier mortgage. And this is a capital repayment mortgage, okay? And the term of the mortgage that you usually take out typically would be anywhere between 25 years and 40 years, depending on your financial situation, your affordability criteria, and also your age, okay? Because that's a really important consideration. And one of the main things is that we use a capital repayment mortgage on our own home. We pay down that debt over the years. So at the end of that mortgage term, at the 25 years or 40 years, come to the end of it, we've paid off all the capital of the loan and we've paid off all of the interest. So we actually own a property now that's hopefully gone up in value over that time, and there's no debt on the property. So it's what we call unencumbered. And one of the main reasons and the mindset and the thinking behind putting a capital repayment mortgage on your own home is that actually makes you feel safe and secure. And if we go back to Maslow's hierarchy of needs, safety needs is one of the 5 things that he talks about as a primary need that human beings need. You know, it gives us stability, it gives us confidence, and it gives us reassurance that, hey, at the end of the day, I've got a roof over my head, I'm living in this property, and I'm paying off the payments every month. And actually, at the end of it, I'm going to own that property outright. And so when you think of it like that, it makes sense. But that mindset is very, very different to the mindset that a buy-to-let property investor would use. Because when you're thinking about growing a property portfolio, we're not servicing the debt, right? We're not making those payments every month to the mortgage provider because that's covered by the rental income. So we're thinking it in a completely different way. And that's the classic mistake that most people make. They take their thinking and they adopt the thinking that they would buy their own home and their own occupier mortgage as a capital repayment. And they think that that's the right thing to do when they're building their property business. And in my opinion, and as you're going to understand as we go throughout this video today and what I allude to, I think it's better to build your property portfolio using interest-only mortgages. And I'm going to explain why as we go throughout the video. But in terms of this capital repayment mortgage on your own primary residence, you pay off the mortgage over the loan term, you pay off the capital, and you pay off the interest. Now, typically speaking on your own home, just for your own understanding as well, the maximum age that you can take out a new mortgage is 60 to 75 years of age, okay? And the maximum the loan term can go up to is up to the age of 80 or 85, depending on the mortgage lender. Now, again, we have to think about the exit strategy whenever we're buying a property, whether that be in our own home to live in, or whether that be a buy-to-let property that we're adding to our property portfolio. We've always got to think about the exit. So if you think about your own home, the exit is, well, hang on a minute, by the time I'm 70 years of age or 50 years of age, when I intend to pay my mortgage off, when the 25-year term expires, for example, I've got to repay that loan. At the end of that 25-year term, that loan amount has to be repaid. And so if you just had an interest-only mortgage on your primary residence, you may think, well, my debt's not being eroded. I'm not chipping away at the debt. So let's say I took out a £500,000 mortgage on my own home. That £500,000 mortgage, if I was just servicing it with interest only, I still owe £500,000 at the end of the 25-year loan term. And when you're in your 50s, you're probably thinking about retirement. You're probably thinking about, therefore, downsizing, or maybe even your income's going to go down in retirement. It shouldn't go down in retirement. And if you're thinking about things well and you're financially literate and you invest in property over the long term, you should actually get to a position where in retirement you're making more money and having more free time. You shouldn't be gaining free time but having less income. But that's the normal traditional curve that most everyday people follow. And so they're into this rationale of thinking that, hey, well, at the end of this loan term, I've got to pay that back. And actually, at the age of 55, if you're just servicing the debt as interest only, you've got this £500,000 mortgage, you've got options, you could refinance, you could remortgage, but if your income's down, you might not have the affordability there. You're probably thinking, where am I going to get this huge capital sum, £500,000, to pay off that mortgage? And that's the rationale by when you buy your own primary residence under an owner-occupier mortgage, why most people use a repayment mortgage. Now, one of the disadvantages of doing a capital repayment mortgage on your own home, though, just as a consideration, is you're actually going to end up building a tax liability more often than not. So let me give you an example just to explain this. So one of the biggest problems that we face in the UK when we're buying assets is we have inheritance tax. When we pass on our assets to our children or our loved ones or our beneficiaries in the future, we have inheritance tax. Now, if we're paying off all of that capital, let's say we bought a property for £500,000, and over the 40-year loan term, we've been paying down the £500,000, so the balance is being reduced constantly over the 40 years, but the property's gone up in value. And let's say that over the 40-year term, the property became worth 1.2 million. And we've cleared the whole mortgage in its entirety, so the 500,000 is completely gone now. We've built up £1.2 million of equity within our own home, within our estate. Now in the UK, the inheritance tax bands are this. You get a nil rate allowance for £325,000 per person, so £650,000 as a married couple in this example. You then each get an allowance of £175,000, so an additional £350,000 that can be used against your primary residence. So in this example, we've got a nil rate band of £1 million, but the property is worth 1.2 million, which is 200,000 bigger than the million. So we've now got an inheritance tax liability if we've paid off our mortgage of 200,000 at 40%, which is £800,000 that our kids, our children, our heirs, our beneficiaries, whoever the beneficiaries are of the property that we give upon demise, would have to pay that inheritance tax bill. Now, that might not be a huge consideration for you. You might be watching this video thinking, well, I'm not really bothered about inheritance tax, and that's okay. I'm just raising your awareness so that you can understand and gain some insights and information around some of the problems of paying down a capital repayment mortgage. There are many ways that you can deal with inheritance tax, which I'm not going to go into any detail in this video, but I just wanted to make that point. The other thing, of course, if you buy it through a limited company and you had to pay down capital repayment, you're building equity in that property, but when you come to sell it, you've got a bigger profit, and therefore you're obviously exposing yourself to a bigger corporation tax bill if you sold the asset by choosing to adopt a capital repayment strategy. Now we know about capital repayment mortgages, why we use them, and the rationale behind using them on our own home. Let's take a look at interest only. Now, interest only mortgage then. So on an interest only mortgage, you just service the interest on the loan. So in this example, let's say we took out £100,000 of a mortgage on a property. Well, that £100,000, we're just servicing the interest payments. We're not paying back any capital contributions. So that £100,000 mortgage, no matter how long we take it out for, let's say a 25-year term, at the end of the 25 years, we've still got £100,000. The balance remains the same. We're purely just paying off the interest. Now, that might not sound that good to you, but actually it's very good as a property investor. And one of the reasons why it's great as a property investor is because it actually allows us to maximize the cash flow position within our property portfolio when we're growing. And I'm going to go through an example with you now that kind of explains that. So let's say we bought a property for £100,000 and we took out a 75% loan to value. So we took out a mortgage of £75,000. Now, if you're somebody who's starting out your property portfolio journey and you're looking to build a real estate portfolio and you're in the early days, the infinite days of building it, I would suggest that you maximize the loan to values as much as you can with interest only mortgages when you're building in the early stages. Okay, because we want to be able to leverage, we want to build up that compound effect, and want to be able to recycle our cash to buy more and more properties and get that leverage position. Well, interest only mortgages allow you to do that, but capital repayment mortgages don't allow you to do that. Okay, it's kind of like the analogy of the bodybuilder. The bodybuilder, when he goes to the gym, he lifts really heavy weights, he consumes a lot of calories, it maximizes growth. The bodybuilder knows that he cannot restrict calories and grow. Right, and restricting the calories is effectively your capital repayment mortgage. You're trying to bulk and cut at the same time, and it just doesn't work. Okay, the bodybuilder has to go to the gym, consume excess calories, lift really heavy weights to maximize growth. Understand that maybe he's going to put on a little bit of body fat, and therefore the cost base in your business might get a bit bloated, but then they're going to trim and they do something called cutting. And that's where you can debt consolidate as a strategy and start to use capital repayments and use them as capital repayment mortgages later on, which I'm going to talk about as we go through the video. Or you can debt consolidate by paying off some of the mortgage amount over the term of the loan. Now, in terms of this then, so if you had an interest only £100,000 property, that you bought, you had an interest only mortgage for £75,000, so 75% loan to value, and you took out the mortgage at say 4% per year. Okay. Now, on an interest only basis, that would mean that your interest payments are £250 per month, roughly. Okay. That's what it comes to. And if you took out a capital repayment mortgage over a 25-year term on the same amount, the £75,000, the mortgage payments would cost you £400 a month. So it'd be an additional £150 a month that you would have to pay to cover the mortgage payments. So Let's assume that the rent on this property is about £600 a month. We'll go for a 7% yield on a £100,000 property, which gives us about a £600 a month of rent income. Remember, when you take out an interest-only mortgage as a property investor, all of your debt is being serviced by the rent that you're receiving from your tenants. Therefore, it's an income-producing asset. It sits on the balance sheet as good debt, as an asset. It's providing you with another income, which is why you need to think about it in a completely different way to how you buy your own home when you may be using a capital repayment mortgage by choice. So going back to this example then, if we've got £600 of rent coming in, on a capital repayment mortgage we'd have £400 going out. Our profit is only £200 a month. Over 12 months, that's 2,400, right? So our cash flow is restricted, compared to if we took out the interest-only mortgage, which was only costing us £250 a month, so £600 minus £250 gives us a gross profit per month of £350 per month, and that means we're making an extra £150 a month by selecting an interest-only mortgage over a capital repayment mortgage. That means over that financial year, we're making £1,800 of additional cash flow by choosing to go with an interest-only mortgage. Now, over a 10-year cycle, that's £18,000 of cash flow that we're better off if we chose an interest-only over the capital repayment. And that cash flow that we create, that £18,000 of capital, we can then keep reinvesting to buy more and more properties to grow and maximize the leverage and the scale of the property portfolio. And that's the main reason why I say that you should use interest-only mortgages in the early days when you're building your property portfolio, because you want to maximize the amount of cash flow and the amount of income coming into the property portfolio, because you can't scale a business without cash flow. So if you're looking to do capital repayment in the early days, it's really going to stop and prevent you from growing, okay? And that's, like I said, the main reason why I would choose and use interest-only mortgages to maximize my position and grow my property portfolio. Now, the other thing you need to consider is this: whenever you're building your property portfolio and you've got an interest-only mortgage on your property, the debt will remain the same at the end of the term. But at the end of the term, you can refinance the property or you can remortgage the property. So that cycle can keep on going. There's not as many restrictions around buying buy-to-let properties when you're buying in a limited company, which I would recommend that you do, because you can actually take out a 25-year loan term on your 80th birthday. Okay, because the lenders see that the company is responsible for repaying that debt and not the individual, which is why it's a completely different set of criteria when you're buying your own home and an owner-occupier mortgage and paying off capital repayment mortgages. So the benefit of being a property investor and buying properties with interest-only mortgages is you can maximize your loan terms as well. So the exit's safe. You can always remortgage the property, refinance the property. So regardless of the loan amount staying the same, that £75,000 loan that we put on the property in our example, regardless of that staying the same throughout the duration of the loan, we can always remortgage and refinance that property at the end of the loan term. So we haven't got to worry about that. So with that being said as well, though, you have to understand one of the main reasons that we use interest-only mortgages as property investors is because property is actually an inflation hedge. And this is the benefit. If you use interest only, you get a huge compounding effect. So check this out. Let's say I bought this property for £100,000 originally. I put a 75% loan to value mortgage on it, so £75,000 as we alluded to, and we're just paying off the interest at 4% per year. Well, let's say every 10 years that this property doubles in value. Now, I'm using that for the example in this video. I've got to use something as an example. And if you're an astute property investor and you look at all of the financial historical data, you'll understand that roughly on average, every 10 years, property prices do double. Now, we are talking in generalist terms here. There are some areas in the country where they've never seen capital growth, but over the 80% of areas in the UK will see capital growth. If you're buying in good locations where infrastructure is being added, you've got new jobs, the economy is growing, and it's developing, then you're always going to see that capital growth over a long period of time. So let's say that this property we bought for £100,000 and in 10 years' time it's worth £200,000. Well, the property's now gone up £100,000 in value and the loan remained the same at £75,000 because we took out that interest-only mortgage. So the debt hasn't diminished, it's been the same. We've now got £125,000 of equity in that property, right? But the other thing is, the biggest benefit is this: that £75,000 today is no longer really in real terms at that point 10 years on. Because of inflation, it's not worth £75,000 anymore. It's actually halved because inflation says, from the financial statistics and economic, that every pound halves in value over 9.14 years. So effectively, what you can buy for a pound today, or what a pound is worth today, in 9.14 years from now, that will be the same as 50 pence. It would have lost half of its value. Okay, so the benefit of having interest-only mortgages on your properties is the debt's being eroded every day that you have it by inflation, and you're maximizing your cash flow position. So if we look at that example, the property went up from 100,000 to 200,000. The loan on the property is still 75,000, and for real terms is still 75. But actually, the value of that 75,000 in 10 years' time is more like £37,500, based on the economic data that I've alluded to there, where a pound halves every 9.14 years. So we're creating this huge compounding wealth formula. And if you do that a lot of times over multiple properties, you can see why property investors get wealthy over the long term. Okay, and this is the benefit of taking out interest-only mortgages. You're using every kind of bit of financial literacy to get your money working as hard as you can using that formula. Now, the other thing is, the other great benefit in that scenario, look, is because the property's gone up to 200,000 and we've kept the mortgage at 75,000, the loan to value on our mortgage actually dropped from 75% to 37.5%. Which means that the loan to value is lower. That means to mortgage lenders, if we went to remortgage or refinance this property and we kept the loan at £75,000, because our loan to value has gone down and it's halved, it's now only 37.5%, we're going to get better mortgage terms, we're going to get a better interest rate, which again means we can carry on maximizing that cash flow position in our portfolio. And remember, the number one thing we want to do as property investors is to maximize the cash flow. Cash flow in a business is king. We want regular income coming in every month so we can service the income, and this income basically services our debt. So we get income producing assets, the income comes in, and it services the debt and the liabilities that we have in our life, okay? And that's what we're trying to create. So we get this compound wealth formula, and this is one of the reasons, like I said, why I recommend utilizing interest-only mortgages. Now, on top of that, the other benefit that we get is that our rents usually tend to go up with inflation as well. So not only do the property values go up in line with inflation, but our rents go up with inflation as well. So in this example, when we had £600 of rent coming in, let's assume that the rent went up to £800 after 10 years. The property was worth 200,000. We've got a lower loan to value and our interest rate goes down. You can see on all of those variables, we're absolutely maximizing our cash flow position, and we're benefiting from all of those benefits. The property's gone up in value, the debt's being eroded by inflation, the true value of that 75,000 is less, our rents have gone up, we're making more cash flow, life is pretty good. And what we can do is with that extra cash flows, we can continue to reinvest it and get that compounding effect. Now, one of the things you could do as a property investor at that point, if it's worth £200,000 in 10 years from now, is you could actually release some equity and you could refinance the property. You could take 75% against the 200,000, which gives you 150,000, pay off the original loan of 75,000 and take £75,000 out as equity, and then put that down and buy some more properties with. And that's a consideration that you could do. But my advice to you is that actually the way that you should buy property is using the buy, refurbish, refinance strategy. Buy a property, add value, refinance it, so that you can keep moving your cash on in shorter periods of time, and then honestly just leave them. So if you just leave them, what that enables you to do in your portfolio is it enables you to manage risk, because the debt on your property portfolio is being reduced. You're building more equity into the portfolio, which is effectively building in better margins of safety. It allows for fluctuations in the market in terms of interest rates going up, maybe from 5, 7, or even 10%, for example. It just gives you a much better cushion for your portfolio to be recession proof. And I'm a very risk averse investor. I want to basically build investments for the long term. I'm not in the game of get rich quick. I'm in the game of getting rich for sure, and wealth preservation, and making sure that my family and my intergenerational wealth can change forever, which means I need to make good, astute financial decisions on perspicacity so that I can grow the business in a way that allows for risk management as well. So that is an important consideration whenever you're building a property portfolio and you are using interest-only mortgages where you're not basically chipping away at the debt. you're using the market to go up in value, you're using inflation as your hedge, then managing that risk profile is very important. So I don't encourage you to keep refinancing. I know there's lots of people talking about keep remortgaging, keep refinancing to grow. That's all very, very well and good. But if you do that too many times, you can get into shortfalls. You can get into deficits if the market goes against you. If interest rates change, all of a sudden you're coming out your fixed term, you could end up being in a bad position and negative equity and not really where you want to be. So that's just kind of like my 2 cents. So, well, let's kind of to summarize then, let's make a summary and conclude on the points and really my recommendations. Now, my recommendation here is going to be a generalist recommendation. In my program, propertyconsulting.io, with our quantum clients, we have a specific dashboard that we use, because the reason I say that is that this is really a subjective thing. Whether you take out interest only, capital repayment, whether you choose to refinance, or whether you choose to keep your loan to value at 50%, 40%, 30%, is really only a decision that can be made based on a unique set of parameters, and everyone is different. Things that will affect those decision-making processes will be strategy. What is your strategy? What is the income that you need that number to be every month? Is it 10,000 a month? Is it 50,000 a month? Is it 100,000 a month? What financial goals do you have? What are you trying to achieve? What is your risk profile like? Okay, all of these things come into consideration. Do you have any other revenue streams, any other sources of income that meant that actually if you used the capital repayment model and built equity, that would make more sense? And again, the biggest thing is age as well. Age is a massive consideration. So one of the things I kind of want to highlight to you is this. There's 2 things really, and I'm going to talk about the first thing before I talk about age, and I'm going to come back to age in a second. But one of the reasons, like my main recommendation is to choose interest-only mortgages over capital repayment mortgages as a general stance, is because one of the disadvantages or the biggest disadvantage of a capital repayment mortgage is this. Although you are paying off the capital and the interest, in the early days of your loan, you're really only paying off like 90 to 95% of the interest. The bank takes that 25-year term, for example, and they say, well, over the 25-year term, you owe X amount in capital and X amount in interest, and they front load the interest at the front of the loan. It's better for the bank, but it's not so good for you as a property investor. And why is that? Well, if you look at this, what happens is in the early days of your loan, if you're just paying off mostly interest, you're not actually building equity into the property because you're not really chipping away at the capital as much, right? And you're decreasing your cash flow position. You know, we're disadvantaged in both of those areas there. We're capping growth because we're not getting cash flow. We're restrictive on cash flow because we're paying a bigger loan, a bigger monthly payment, because we're paying capital and interest, and most of what we're paying is interest anyway, so we're not actually eating into the capital to be able to leverage our position. So it really hinders growth. And over the maturity of the loan, as you get towards like the 15-year term onwards, that's when you start to pay more of the capital balance off. So you see your benefits much later on. And for me as a property investor, obviously, like I said, I want to maximize my cash flow position. So it doesn't really make that much sense financially to have a capital repayment term on my mortgage. What I'd much rather do is have an interest-only mortgage, maximize my cash flow. And this is another key consideration as well, because on an interest-only mortgage, you can pay off 10% of the mortgage loan value of the outstanding balance every year without any penalties. So if we look at that £75,000 loan, based on the cash flow that we make, and we're maximizing our cash flow position just because we're on interest only, we could save that cash flow and just pay down the capital balance. In my opinion, by 10%, so £7,500 a year for 10 years means at the end of 10 years, we actually don't have a loan on that property. For example, if we're able to pay down the £7,500 as a general kind of consensus across the portfolio, you could do that, and that would be my preferred option as opposed to capital and interest where I'm doing a repayment mortgage to clear the balance. It makes much more financial sense to take out the interest only mortgage, maximize the cash flow, and then use that cash flow to either reinvest or save that cash flow and decrease and debt consolidate the loans by 10% every year without penalty. That in my mind just makes more financial sense. So that's what I would encourage you to do. Again, all generalist advice up until this point. And then the last thing I like to think about is this, like there's a good strategy that you can deploy. And this isn't my strategy, by the way. This is a strategy that I've learned from observing other property investors in the space. I believe that other people in space do have good ideas and they share great content as well. So one of the things that I took away from somebody else was this. They talked about this model where effectively you start off by building your property portfolio in a way you take out maximum leverage, 75%. Makes total sense to me. Then every 10 years or 12 years, so every decade, you decrease your loans by 10%. So let's look at this. It meant that maybe in your 20s, you take out 75% loan to value. And when you're in your 30s, you reduce that 75% loan to value and debt consolidate by 10%. So that now comes down to 65% loan to value. When you're in your 40s, you debt consolidate again by 10%, so your loan value is 55%. When you're in your 50s, debt consolidate by 10% again, so we're at 45% loan to value. When you're in your 60s, you brought the loan to value right down to 35% loan to value. And that just allows for like that stage of your life to feel safer. You've built equity in, you've got less risk, less exposure, and you've probably got that monthly cash flow that you want. And at that stage of your life, it's going to be more important if you haven't got a job or another income because you've decided to retire. So that makes a logical sense from wealth preservation, from building the portfolio, building the desired income that you want, at the same time safely managing your portfolio. So that to me, I thought, well, that's a really good piece of advice. I'll share what I've learned there and what I've heard with you guys as well. And it's a model that I'm going to start implementing in my portfolio. However, with that being said as well, again, it's very, very subjective. All these things need to be considered based on, like I said, your age, your parameters, where you're at in life, what you're trying to achieve. And like I said, we have this model and a spreadsheet that works out with all algorithms that help us to work out what's the best thing to do at any given time based on a unique set of parameters. So if you're really wanting that individual kind of bespoke support and want more insights about that, then click below. There's a link and you can book a call with my team. And if you want to work with us, great. And if you don't, that's equally fine as well. You'll take a lot from your initial 1 hour consultation with my team anyway. But these are the types of things that we consider when we're building out the property portfolios, using algorithms, using metrics, using data to make all of our financial decisions, to make sure that we're not overexposed. We're managing safe things safely, securely, and diligently, at the same time maximizing our leverage position to maximize our cash flow based on a number of parameters of the goals that we have, how much income we want, how old we are, and all those other premises that we talked about and considerations that have a variable effect on what decision we ultimately make. Now, as you've seen, you don't always have to pay off the loan to value, because if the market reduces your loan to value, like we talked about, where actually even if we're taking out that interest only mortgage and the debt remains the same, in the example where they probably went up from 100,000 to 200,000 in 10 years, straight away the loan to value reduced anyway over that 10-year period by actually half. It went down by 37.5, right? Because we had the mortgage at 75,000 against 200,000, that's 37.5% loan to value. When we initially bought the property, we were at 75% loan to value. So we saved 37.5% just by the market. The market actually done that for us. So there's no need to save that cash flow to get consolidate. We can actually save that cash flow and buy more and more properties to leverage out the portfolio and get that over the whole portfolio. A nice balance of loan to value, 50% or less is my recommendation over the long-term growth of the portfolio to keep things safe and secure. And again, that's where you get your best loans, your best interest rates at 50% or less. But in the early days, you definitely want to maximize growth. And in the early days in my portfolio, I always went up to 75%. I always looked to refinance and get my cash flow working for me. But as you mature, as you grow your portfolio, you have other options and considerations to make. And like I said, you don't always have to pay down the balance and debt consolidate, because sometimes the market can do it for you. So it's just keeping a finger on the pulse. What is the market doing? Reviewing your portfolio every single year to see what the numbers look like. What are the new values? What did you buy them for? What's the current loan to value on the portfolio? Has it come down because the market's gone up? What did inflation do this year? What's the real term of my actual value of my pound today? And then you can make those better decisions. So hopefully you enjoyed this video. If you did, please go ahead and hit that like button. It'd really help us. If you haven't already and you're new to the channel, make sure you subscribe and hit that bell icon so you can be notified of more content. And again, like I said, if you are looking to work with somebody, you are looking to leverage your portfolio and make better decisions, astute decisions based on your own individual parameters, then click the link below and feel free to book a call. Last thing, I need to put a disclaimer into this video. I'm not a financial advisor, so none of this constitutes as financial advice. This is my own opinion of what I've done as a property investor, having analysed over hundreds of portfolios for anything from 1 all the way through to 144 properties, seen lots of different assortments of portfolio structures, and basically learning myself over the last 12 years of being a property investor what makes the most financial sense. Doesn't mean to say I'm right. Hopefully you enjoyed the video. It's my opinions. And like I said, if you want to work with us, click the link below and you can book your first call and we'll have a chat and we'll see whether it makes sense. All right, see you in the next one.